Welcome investors. Inflation data this week shows that inflation is continuing to decline. Blowout Black Friday numbers. But the articles and the news have left out two key important metrics that we need to understand. And what does this all mean for the stock market and the rental and real estate new and used home market? Let's dive into it. But before we do, if you find value from this video, be sure to like our video, subscribe to our channels, so you can stay ahead of the curve with our weekly market videos. I'm your investment advisor, Jake Ackerman. Let's just dive right into it. All right, so what did we have this week? We had some new inflation numbers. All right, so inflation slows again. The Fed's preferred price tracker shows. Inflation is on the decline, but inflation being on the decline, I think that was already kind of baked into the cake at this point. Is the Fed going to raise interest rates further? If inflation keeps declining and showing in the data, they don't need to raise interest rates anymore, because that means interest rates are high enough where they are right now to continue to bring down inflation, slow down the economy. And that's the objective of them raising interest rates, is to bring down inflation, which the only way to bring down inflation is really to slow down the economy. And that's what they're having to do. So let's switch gears. Black Friday numbers, big blowout. We've seen the articles, we've read the headlines, the consumer is strong, everything's good. But is that really? They've left out a pretty key important factor here, and that's the numbers don't include retail price inflation. Yeah, numbers are up 7% year over year, but where is that in comparison to the inflation? That means the rise in prices of those goods for your computers, for your laptops, for your toys for your kids, your basketballs, footballs, whatever the case is. They're not including those increase in prices. Another key factor that we need to think about is the reason people were able to spend so much this holiday season so far, and we're not even into Christmas time and Hanukkah and all the other holidays at the end of December here for New Year's. People are putting their purchases on long-term payment plans. And if we're in this everything is all good, why are people putting things on credit further? Because they're out of their credit card limit. They're at capacity with their credit cards, so they have to find a way to get credit somewhere, and that's why they're putting down these payment plans. People are going to spend until they absolutely can't no longer. So really, the numbers are blowout, but they forgot inflation numbers. They forgot to add the inflation metric. So it might look good on paper, but in reality, it's not as strong as we all perceive it to be. Let's shift into the stock market. And what is continuing decline inflation? Even though inflation is declining, Fed's going to keep interest rates high for as long as they can, and showing that the consumer is, yeah, they're still spending, but they're running out of credit. They don't limited savings at this point. They are slowing down with their purchases, and things are slowing down. We need to talk about the correlation between the interest rate markets and the S&P 500. So what I'm going to put up on your screen here momentarily is the Fed funds rate in the S&P 500, which is the biggest Fortune 500 companies in the U.S. And the Fed funds rate is the interest rates that the Fed controls. When they raise the Fed funds rate, it has effects across all interest rate markets. So we'll see the ramifications in the 10-year interest rate, which really what some of the institutions borrow at. They also borrow at shorter terms as well. And then even the long term, the 30-year interest rate. 30-year interest rate is the 30-year mortgage. Buyers and sellers, or consumers, other investors purchase real estate at that 30-year mortgage. So it has ramifications across all interest rates, from your short term all the way till your long term. So that's what we need to understand as we look at this. So again, what I have here is your Fed funds rate and your S&P 500. The blue is the S&P 500. The orange is your Fed funds rate. So look what happens. Interest rates go up. Interest rates really go up, and pause and cut because we're in a recession. Again, let me see this. Interest rates go up, and pause and cut. And now we're in a recession. And they didn't get the raise interest rates very much over 2015 to 19 because they cut. And now we are now, interest rates up, and pause. And to be determined what happens. But we can see through history, and I only gave you 30 years, we can go back another 30 years and see the same correlation. High Fed funds rate, high interest rate market followed by a pause, following to a cut because there's economic damage. And when the stock markets goes down, that translates to, not always, but most of the time, the real economy. When the real economy is getting bad, that's going to affect companies' earnings and how they can be profitable in the future. So these are downstream effects. These are, Fed funds rate affects the real economy, and the real economy affects people's spending, leading to stock prices going down because their earnings aren't as good. So now, again, we can see the correlation between interest rates to the stock market. Now, what's the correlation over to the real estate market? We're going to start with the rentals. And I have a couple articles that I pulled from some real estate investment companies, some big real estate companies, and they're not very good at forecasting how prices are going to go up or going to go down. I think they have too much conflict of interest when it comes to determining the market, because obviously they want the market to go up. So they're going to ignore some of the things and have confirmation bias when it comes to prices. However, they still pull out good data. And they've highlighted the Airbnb market because that is the vacation rentals. And that market was super hot the last couple years following COVID. Everybody wanted to buy an Airbnb. They're making a lot of money per month. But what's happening now? Things are shifting for the vacation rentals. And again, I'm just highlighting Airbnb because it's one of the biggest ones in the United States, and if not the entire world. So let's put up a couple things that these real estate companies have noticed. All right, so one, the decline in travel demand has resulted in fewer bookings and a decline in rental income, making it difficult for many landlords to cover mortgage payment, property maintenance costs, and other expenses. Another thing to note, as more properties have been added to the platform, the market has become saturated, leading to a slowdown in revenue growth. Additionally, economic fluctuations and tightening finances have further impacted the demand for short-term rentals. So as the short-term rental market, vacation rental market, becomes oversaturated, people aren't making money with that. There's a couple things that could happen. One, they're going to list their property, sell it because they can't keep up with a mortgage payment. Or number two, instead of doing the short-term vacation rentals, they have long-term rentals. And the long-term rentals, you're not making as much potential profit because you're not charging a lot for a short-term period of time. You're having a year, maybe a 2-year lease at most, and the prices need to be where the market is. And where the market is right now, we're starting to see it come down because there's people that had the vacation rentals are now listing their house on a long-term basis. And that created more supply in the long-term rental market, and long-term year plus, all right? So that's what we're seeing now. So there's more supply. So we're seeing rental prices come down. We're also seeing, as rental prices come down, housing prices don't need to be as high. As housing prices come down, that also has an effect on the rental prices, because if I'm purchasing a house for a less expensive price than prior, housing prices coming down, I no longer need to make as money with rent to get the same return on investment. So that's loosening up. And I hear all the time, Jake, there's just no supply in the real estate market. We're not going to have supply for another decade. It can't come from anywhere. That's just not true. Again, you have vacation rentals, short-term rentals. The people that aren't making as much money now can go and list them because they're not getting their return on investment as expected. They can't keep up with the cost to maintain it, and they can't keep up with the mortgage payment because they paid such a high interest rate. So that's more inventory. Another place that inventory can come from is new home construction. So I have this article here, Housing Under Construction, data published monthly by the U.S. Census Bureau. The units displayed are in the thousands and seasonally adjusted annual rate. And what you can see here is up, up, up. And we really have a lot of new construction over these last few years. And it takes time to hit the market. Next, 16 million vacant homes in the United States. Look, we may not see the inventory right now, but the inventory is clearly out there. And if there's going to be more supply, there's really very limited demand right now because interest rates are high. They're going to come down a little bit as the market anticipates the Fed likely going to be cutting rates in 2024. Interest rates are going to preempt it. They're going to come down beforehand. But again, there's limited demand. Interest rates will still remain high for as long as the Fed can keep them high, as long as the market keeps them high. But there's going to be more supply coming on the market, bringing down prices. Supply and demand, folks. Supply and demand. Stay with us next week. We'll talk about some more inflation reports, some retail sales. We'll keep you updated and ahead of the curve. Expertise you deserve, experience you can count on.